Hello everyone, this is Rob McDougall from Zhang Financial here with your weekly economic update. Today is Monday, August 3rd, 2026. Lots of economic data points from last week to go through. So we'll start with last week. Durable goods orders, a little short of expectations. For June, it came in a positive 0.3% for June, but was expected to be up 1.6%. Housing price index on Tuesday, no real change there. The expectation was a positive 0.2. It came in at positive 0.3. You could look at that either way. But the big thing last week, Wednesday, the Fed interest rate decision, FOMC, left rates where they were, the range of 350, 375. So no change there. As a result, we're going to take a look at what happened in the bond market last week, particularly to long rates as a result of the FOMC, not so much the decision, but the discussion or lack of information coming from Kevin Warsh, Fed chairman. Then on Thursday, initial jobless claims, just another outstanding week. It's just very impressive. The number of times we've been under 200,000, and recall 6 months ago or so, we were averaging 230, 240,000 new jobless claims every week, and for a number of weeks over the last couple of months, we've come in well below consensus and below 200,000. So last week, 197,000 new additional claims. One negative, certainly, GDP growth. Last week, Thursday, was announced. The expectation, the consensus was 2.3%, but you may recall we tracked the Atlanta Federal Reserve and their expectations. They were much lower than that. I believe they were 1.7% coming into the week. So 1.5% GDP growth, certainly in that ballpark. So we're not so surprised that the actual is 1.5 versus consensus at 2.3. Personal income, personal spending, both a little worse than expected for the month of June. Personal income was expected to be at 0.3, came in at positive 0.2. Personal spending expected to be 0.4% month over month, came in at 0.3. Now, probably the biggest or the best bullet point here for the entire week was core PCE, personal consumption expenditure. For June, that came in a positive 0.1%. That was expectation, but very good to see. That's the inflation index that the Federal Reserve uses for policy setting. So a 0.1% PCE increase month over month, very solid. Lastly, the Michigan Consumer Sentiment Index, which I often criticize on this podcast and will continue to do so. Nonetheless, expectation was for July was going to come in about 54.4, but better than expected, 55.2. Couple of other data points from last week. Inflation expectations inching up a little bit. The 10-year break-even, 10-year Treasury minus 10-year tips came in at 2.28%, 2 basis points higher than a week before. The GDP estimate, this is the first estimate for the Atlanta Federal Reserve for the third quarter. This will change, I'm sure, and it'll probably change dramatically next week, but the first reading was for an expectation of GDP growth of 5% in the third quarter. I'd be really, really stunned if that actually happens. Fed funds rates. Now, the expectation for the September meeting is that we will get a rate hike. 72% probability now built in. Last week, that was 55%. And by the end of the year, a lot of movement here. So the odds of no rate hikes or cuts, certainly no cuts, but no rate hike is only 9%, 37% probability of one hike. That was 31% last week. 42% probability of two hikes, which was 39% last week. But the odds of 3 or more rate hikes went down last week. It came in at 12%. It was 22% previous week. Lastly, we'll just give you a recap update on corporate earnings, S&P earnings. This has been just off the charts good. So through last Friday, 61% of S&P companies had reported their earnings, 86% beat consensus, well above the 5-year average of 78%, 10-year average of 76%. But the real crazy number is the magnitude of the beat, which is 31.4%. That's slightly above the 5-year average of 7% or the 10-year average of 7.4%. But as we mentioned last week was impacted by the Alphabet non-operating income. I believe that was a SpaceX hit. And last week for Amazon, likewise, they got a huge bump to their net earnings due to their Anthropic holding. So if we X both of those out, the magnitude of the beat is still very impressive. It's 9.2%. Again, with Amazon and Google or Alphabet, it's 31.4%. But 9.2% average beat is well above the 5 and 10-year averages. So it looks like just on stark numbers, again, with that Amazon and Alphabet non-operating income, that the quarter would end, if it were today, it would end up 47.4% in terms of earnings growth, which is well above expectations a week ago, or coming into the quarter the expectation was an increase of 23.2%. Now, if we X out the Google, the Alphabet, and the Amazon, that 47.4 drops to 28.8%. So 28.8% is the earnings growth on the S&P 500 X Alphabet X Amazon. That is really, really impressive. So in terms of how the markets responded to the news last week, a little volatile, certainly the Fed meeting, very choppy trading. Equities here in the U.S., good. S&P 500 up about 1.1%. Mag 7 up really strong. Last week up about 4.1%. So now, year-to-date, S&P up a very solid 10.1%. The equal-weighted S&P 500 up 13.1%. And the leader here in the U.S., small cap, Russell 2000 now up 18.9% year-to-date. In terms of international markets, developed ex-U.S., better week than the U.S. slightly, up 1.8%. Emerging markets, another really, really strong week, up about 2.4%. So year-to-date, emerging markets almost double that of the S&P 500, up 20.04%. Now, I mentioned with the Fed meeting and some gyrations in the bond market post that, that the fixed income yields went a little crazy. Indeed, it did. The 2-year yield was actually down 5 basis points, good for bond prices. However, the 10-year was up 5 basis points. So the Bloomberg U.S. Aggregate Bond Index was down slightly, it was down 10 basis points, but the U.S. Long Government Float Adjusted Index, with about a 20-year duration, down a full 1%. And that index year-to-date is now down 3.6%. So this week, earnings activity, or I should say economic activity that will be reported. Today, ISM Manufacturing, PMI, the month of June came in at 53.3. That's expected to come in at 54.0. Tomorrow, we'll get the JOLTS job opening, which the month of ending the month of May, that was about 7.6 million. That's expected to drop to about 7.3 million. Also, on Tuesday, we get the factory order month over month. The month of May, that was down. It was down 1.3%, but it's expected to rebound to be at 0.5%. ISM services on Wednesday, that's expected to come in at 54.2% for July, pretty much in line with what we saw for June. Initial jobless claims on Thursday, again last week, really strong at 197,000. That's expected to be up slightly at 200,000. But the real activity will happen on Friday. The big one, non-farm payrolls. Now, last month of June, only 57,000 new jobs. The expectation is an increase in that to 91,000. Unemployment rate is expected to move up slightly from 4.2% to 4.3%. And average hourly earnings is expected to be up month of July, 0.3%. So, that's it for our economic recap. We thank you very much for your attendance. We look forward to seeing you next week. Thank you.